The Finance Minister's budget on February 1 has rightly focused on nation building. The four key areas for building our nation: agriculture, employment, health and infrastructure, the forefront of where the government proposes to invest in the year ahead and in the years to come. And a massive dose has been given in these areas. However, as expected, thanks to GST and the fact that GST gives revenue only for a part of the year, which is 1 month short, the budget deficit has slipped from 3.2% to 3.5% as estimated for March 2018. At the same time, as we move into the election year, next year's expectation of the deficit is up to 3.3% from the original plan of 3%. So some of this is going to put pressure in terms of government borrowings and on the bond market yields. However, what we have to watch is how inflation performs, particularly with the potential increase in MSPs as well. On the equity markets, in terms of the introduction of long-term capital gains tax has been done in a non-disruptive manner. By grandfathering the gains up to 31st January, the government has rightly protected on a retrospective basis and said that going forward, if people make money in the equity markets, even if it's held for more than 1 year, give us a little bit, which is 10%. So I am quite comfortable with the way long-term capital gains tax has been introduced, and it's in a very fair and equitable format. The second issue, of course, is mutual funds. Dividend distribution tax of 10% is consistent with the concept of long-term capital gains tax at 10%. However, what will also happen is, in the case of equity mutual funds, the arbitrage funds who were earlier getting money out to investors as tax-free dividends will pay their fair share of 10%. This effectively will increase the cost of financing for people playing in the derivatives market, but that is completely fair because even now at 10%, it is lower than the marginal tax rate of 35%. I also welcome the Finance Minister's move to increase the limit of turnover up to which the tax rate will be 25%, and that is increasing that limit from 50 crores to 250 crores. So all companies with turnover of less than 250 crores for the year ended March 17 will now have a marginal tax rate of 25% instead of 30%. All in all, considering that this was the last budget before potential Lok Sabha elections, the Finance Minister did a balancing act between the needs of the nation, which he put at the forefront, the economic challenges, and the balancing between the financial sector as also both debt and capital markets. Yes, the fiscal deficit is a tad higher than what most economists and markets would have liked. But keeping in mind that we've seen the major disruption post-GST, it is not that big a move. I do believe this budget will be the bedrock for an exciting year ahead for India, keeping in mind that there is a global tendency for interest rates to go up, and India too will pay a little bit of a price in terms of higher interest rates. From here, it is now going to be over to the RBI in terms of its next steps on increasing interest rates.